Right, let's talk mortgage structures. This is the single most important thing that you need to get right, because if you don't, you could pay expensive break fees, higher interest rates than you need, and it may not give you the opportunity to make extra repayments, or it just means that your whole mortgage will come off at the wrong time and interest rates will be way higher than they were when you got them, and you'll lose lots of money. And this is like one of the key reasons why you use a mortgage broker, because we give you advice on how to structure your mortgage based on your individual situation and of course what's happening in the interest rate cycle. So on screen I'm going to show you 3 examples. This is not financial advice, these are just examples, and the key thing that you need to factor in is I'm doing these examples based on today. In the future my examples might be different, and every time I speak to a client about their loan structure I say, you know, in 2 years time my advice would be different than this because things change. So for each example, I'm going to do the pros and cons and compare it to the others. So in all 3 examples, I'm using a $600,000 mortgage amount. And example number 1 is that you just put your whole mortgage on one term. In this example, it is the 1-year term. So the pros and cons of this is that all your eggs are in one basket. So if, for example, interest rates go up in a year's time and that whole $600,000 comes off, which it will, then it's exposed to whatever interest rates are at that time. Now, during COVID, a lot of people fixed their mortgages for 1 year. The interest rate at that time was 2.29%. A year later, it was at 5% plus. So there was a massive jump. So by doing all your mortgage on the same amount, it doesn't have to be the 1-year rate, you are putting yourself at the most risk. So to mitigate that, example number 2 is you split your mortgage either in half or in thirds and put them on different terms. In this example, I've just split them in half. If you were to split them in thirds or fourths or fifths, the more splits, then obviously the less risky and the more flexible it's going to be. I think for this mortgage size, you're thinking only halves or thirds. And you don't have to do halves or thirds. You could do, you know, one of it on 200, the other one on 400. If you did it in halves, then the function of doing this means that half of your mortgage is coming off in 1 year, the other half is coming off in 2 years. And you would just make sure that as you refix, you stagger it so that your whole mortgage doesn't come off. The advantage of this is if interest rates go up, only half of your mortgage is exposed. So it's not going to make a big jump because your other half will still be on a lower fixed term. The disadvantage obviously is if interest rates have gone down, only half your mortgage will be exposed and be able to get them. But there is a much bigger difference in the quality of your life if interest rates will go up versus if they went down. And then option number 3 incorporates an offset account. Now, offset accounts are something that you probably already have learned about because you watched the other videos, and whether you have one or not is up to you, or if you spoke to me as, you know, me being your broker, I would advise you on what I think you should do. Clearly, you need to make sure that you have enough money or close to enough money as this budget. So this one is a $40,000 offset account, and then splitting the remaining mortgages on fixed terms so that you have your offset, ideally with $40,000 in. That amount there that it says of $58 per week would only ever be charged if there was no money in that account, or if it was a principal and interest, then it would go to the principal directly. Watch the offset account video if this doesn't make sense. So that bit would be your offset saving your interest, and then you would have your fixed terms reducing risk by splitting them. Of course, you could split it in thirds and still have the offset account. But those are some 3 very basic concepts of how you would structure your mortgage on one property. If you had 2 properties at different banks, you'd want to incorporate that as well. But remember, this is your first home we're talking about. The investment property stuff will be in a different video. So hopefully that makes it easier for you to understand the pros and cons of maybe what you're thinking of doing. Ideally, why not use a broker to help you with this, because we're free, and there is a link at the very bottom of this course to work with me if you want to apply.